Stocks rallied hard again today, filling in last week's gap that we talked about, as well as making a run up above some resistance and maybe making a run towards another layer of resistance. So we're going to talk today. We've been talking about this bandwagon of retesting the lows, and we're going to talk today about whether or not we've knocked off enough people off the bandwagon with today's move, and how likely it is that we'll continue to move higher, and how likely it is now that we'll retest the lows, and if we do, where? How far down will we go, and where will we go down to? So I'm going to break all that down in today's video. We're going to also talk about some interesting moves in different asset classes, and also in some of these sectors with today's move, to see whether or not we are going to form the low point on the next leg lower, or if we still got some time to go. So I'm going to break that down. And then our trade idea of the day takes advantage of a stock that's kind of giving us some false breakout patterns. We're going to talk about how to trade that. So let's go ahead and get started. Today is Monday, April the 6th, 2020. This is the market outlook from marketscholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. And you can see the nice little bounce we had today, getting us up through kind of, again, we talked about this idea of retesting these lows, but in a way that not a lot of people expect. And, you know, we have to clear a lot of people off the bandwagon before we really can drop where we think we will drop to. And, you know, today might be that day. There wasn't very much talk about retesting the lows anymore, and the fact that we cleared these highs right here and filled in that gap that we were looking to fill in last week. We filled in Wednesday's gap. There's still a little bit of a gap over here that we need to fill in, and that might be tomorrow, as early as tomorrow, if we follow through today. You know, again, light green shading we talked about in this last video about how we go from dark pink to light green. Again, we go from light green right back to dark pink really easy too. It might take a day or two, but don't be surprised if we go right back to dark pink. But this time probably we'll get a yellow line first. Remember, the yellow line, like the moving average today was right here, but tomorrow you can see the moving average is going to be down a little bit. So obviously, depending upon where we end up opening tomorrow too, will impact that. But as of right now, that's where the moving average is going to be tomorrow. So you can kind of get an idea of how close we will be to getting a yellow line. And again, light green shading in the yellow line. You know, we hit the 17-day moving average here. We came down. We're hitting the 30. To kind of give you an idea again of what it looked like. And the most recent significantly horribly bad sell-off day that we've ever had in 08 and 09 that everybody always goes back to. Again, once we hit the 17-day, we got light green shading. We came down, got dark pink again. This one we went a little bit lower, but not than the lower shadow, right? We stayed above the lower shadow there. But then we rallied up and got the light green shading again with a yellow line this time before we came down. And then went not only retested these lows, but went a little bit lower. And then 2 days later rallied back up on November expiration. So, like, again, you have to get people off the retesting the lows bandwagon before you really do it. Again, market is in the business of causing pain, and if a lot of people are expecting us to drop down to there, to these lows, if not lower, or maybe even just to this level, then that's not causing a lot of pain. So it's going to move higher until fewer people expect us to retest those lows, because they think, now here we go, we're going back to the upside. So keep that in mind, and also keep in mind too, retesting these lows can mean a lot of different things. We might go lower. 2100 is the area we've talked about going lower to. If we do go lower, we might stop right here at that gap, if that's a runaway gap. And we've done that in a lot of stocks, individual stocks. We've some of those stocks pulled down here towards that gap and then bounced off today. So that might be the case. We might fill in that gap. We might not fill in that gap. That's a possibility, right? The likely scenario is we come down and we stop right around this 2350 area. We drop below 2400. We get a lot of people going crazy again because of how high we've gone up before. And then we end up holding that support and rolling over. We'll see if that ends up being the case, but that's a very likely outcome, kind of that as of right now, that I'm expecting. And like I said, if we fill in that gap, then at worst a move down to 2100, where there's some significant support on the 5-year Bollinger Band, right in this area, right around 210, which would be 2100. That's kind of where I expect. And again, the bottom of that gap the top of that gap, excuse me, be right in this area right here, right around this 2, what was it, 2, let's go back to this chart here really quickly, 2350, well, right around 2350, so that'd be 235 roughly on this chart. Right, the dividends kind of change that a little bit, but if you go back to here, and let's get rid of this probability of expiring cone for now. So right in this 235 area, right? So right at the bottom of this volume node is where that gap would be. So there'd be some support there from a volume standpoint if we were to reach that level. Again, you can see the bandwidth on SPY and the weekly chart's really spiking. Of course, on the daily chart, it spiked and has been now coming down. All the volatility levels have been coming down. But one thing to keep in mind too about this rally is, I mean, great to close above these highs. Closing above 2750 would be a significant move to the upside, because you'd be filling in that gap, and of course 2800 up here, and you'd also be closing above the green line. I think that would be the level where you get a lot of people saying, okay, now this is V bottom, and that would clear the bandwagon significantly, and then open us up again to fill in today's gap, which, I mean, today's a 7% move to the upside in the S&P. That's not a runaway gap. There's our runaway gap right there. That is very potentially just a regular common gap, which is very likely to get filled in. It doesn't have to get filled in today, obviously, as you saw. It doesn't have to get filled in tomorrow. It might get filled in by the end of the week. It might get filled in next week, like some of these gaps did over here. But the reality is there's a good chance here in the near future that we fill in that gap this morning. That's why I didn't like that gap. As great as the market was doing overnight, you don't want a good move to occur overnight because it's very, very light volume, and it gets filled in really quickly. The other thing too, in terms of how bullish we are, again, on the RSI and the CCI, when you kind of use these in conjunction, when the RSI gets above 60 and the CCI gets above 200 and then stays there, because you might get a little bit of something like this where we kind of dip down, dip up, dip down, dip right back up. This was a dip down in 1 day below 40. We dip right back up. So if we were to get above 60 and above 200, and at least on the RSI stay above 60, then we are V-bottoming, and we're probably going to move up, and here we go. From at least up to the 200-day moving average, right? Because that's the level that's the make or break level of whether or not we are going into a bear market or whether or not we are turning right back around again. So that's why, again, I'm not too sold on this bullish bounce, is because we're not seeing the RSI get above 60. Not even close. It's not even above 50 yet. The CCI has barely got above 100. It's not above positive 200, which is what you look for when you're getting a trend reversal to the upside. So that's not there yet. So the divergence has played out. I don't think we'll get all the way up to these highs here. We could, but I don't think we'll get all the way up to these highs. I think we'll get up towards this 2750, maybe a little bit higher to, again, sucker as many people in as possible to this idea that we're just rallying from here. And then we come back in and fill in gaps and retest lows, at least down to 2350. That's kind of my expectation. You can also see, too, another reason why I'm not too sold on this bounce is the positive just barely crossed above 20. With this move, the positive still not above 25 and just barely crossed above 20. The negative index still hasn't crossed below 20. Itself hasn't crossed below 20. So the ADX is still falling, which means you can still get some bounces here on the purple line and fall and drops on the blue line, form some higher lows, lower highs, while the ADX continues to drop before we finally settle in. So, which means, again, retest of the lows. And then finally, the other thing too, the Ichimoku cloud, we are flirting with getting above the blue line on the Ichimoku cloud. You get above that, it's a very overbought signal. Again, it's a bearish signal. So especially when you're as far below, like we're so far below the Ichimoku cloud, we're not looking to turn this around anytime soon. And same thing with the long-term moving average. Here we go. Long-term moving average again. We're not even to the 50-day moving average yet, much less filling in the gap between the 50 and the 200. Alright, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also a subscribe button down below our video if you're watching us on YouTube. That will notify you when these videos are posted on our channel. Also hit the thumbs up icon down below the video. That tells us two things. Number one, you liked our video today. Number two, that you want us to do it again tomorrow. It's a quick way to give us feedback. It's our survey that we send out essentially after every video to see what you're thinking. If you like these, let us know. If you don't like these, you don't have to click on anything down at the bottom. Also, while you're down there, comment. What did you get out of the video today? Everybody always checks the comments to see, you know, how good the video was or why they should watch. And so post down there what you got out of it. It's also something we'd like to see, just to kind of see, you know, what we're covering in these videos and how useful they can be. Join our website at marketscholars.com. There's a link popping out right there in the top right corner of your screen. Click on that link where you can subscribe to our site for free. Follow me on Twitter for more content in between the videos from day to day. And join our Market Outlook Facebook group that we've created. Also, if you're watching this on our video, we invite you to check out some of these other things here on the site. Our calendar, the Market Outlook trade review, where we go back over past trades, trade ideas we do in these videos. We also posted today's trade already before the market closes. So if you want to get the trade idea before the market closes, that's where we post these here at 3:30 Eastern time. You also see the links up here at the top. There's our classes. Our monthly subscribers, our plus subscribers, get access to all 8 of our trading rooms. There's a breakdown between the differences between our monthly and our premium subscribers. Our premium subscribers also get access to those trading rooms, plus our 2 Q&A sessions every week, as well as all the premium tools and resources that we offer. In addition to access to all the communities, right? These are all the communities forums for each of the classes where we post all our custom content that we create there. We also invite you to subscribe or engage with us, on social media. Hit this heart right here. It opens up a window. You can like the Market Outlook tweet there. Click this thumbs up. Do the same thing on Facebook. Again, the more you engage with us on social media, the more those platforms will promote our content to you. They only promote the content that you engage with the most. They really highlight that. So we try to make it really easy for you to do here. All right, another thing that really stood out in today's video here, let's go over here, that really stood out today, I'll come back to this chart in just a minute, but one other thing that really stood out was the daily changes. So it was this one, 60. So again, we've seen big moves to the upside. They've typically come after big moves to the downside, and then we see what happens. Like here, we had a big move to the upside, and we followed it up with some smaller upward moves, a little bit more of a move up, in this case to the 17-day. Are we going to follow up this really big, 7% move? You notice that we don't get, you notice how singular these are. There's, in between, there's spaces in between these, and these all had red spaces in between, and these, for the most part, had some red spaces too, and with a small green space. So again, we might get a small green tomorrow, but again, don't be surprised if if this is enough and we start getting some red. Again, I don't expect big red, and I don't expect, the big moves like this. But if you see how big this gap is between the historical volatility and implied, that typically gets resolved by move higher in implied volatility, not to exceed, and not we're not going to get up to 100% on the VIX, right? To 100. We're not going to get up. We probably won't even get up to 80. We probably won't even get up to 80 here. We made a big drop down below 50, but again, a lot of these types of moves, these types of gaps here in the past, get resolved not by historical volatility dropping all the way to these low levels as sharply as VIX has dropped, but for VIX to rise up as the historical volatility is dropping, for it to make a little bit of a move up higher and then turn back down below the historical, and then that's usually when we set in the low point, wherever that ends up being here on the chart. So that stood out to me. Of course, we talked about this. This candle, we had this transition candle. Well, just like that, we're to a bullish candle here, and we'd have to, because we opened up so much, right? We were down here on Friday at the close, but we opened up so much, so we ended up getting above the open of the Hakinyashi, which again is an average of the open, high, low, and close, or excuse me, the open is the midpoint of this body right here. The close is the average of the open, high, low, and close of the regular candle on the weekly chart here. So pretty bullish candle. Obviously, we're not closing above that period's high. It's You can kind of see the reversals here when you do close above that period's high point. Here you close above that period's high point. So when you can close above this candle's high, that's a good sign. We'll see if that ends up being the case, right? Again, it's a close is an average of 4 prices. So you'd have to have all 4, right now, really the high and the low. The high this week so far is 26.76. So we have to start to push that up and close up, because you see how much higher the high got on that one. See how much higher the high got here from that body. So we have to push that high up probably a little bit and close right on the high for us to get above that candle and really kind of feel good about a bullish reversal. And that may go beyond just getting us to the, see how far away the 50 is? I mean, that's a pretty decent move just to get up to the 50. I mean, that's about another 100 points to the upside, or about 10 points on SPY to the upside. The PPO is slowing down. It's a good sign. It's not surprising. We saw the signs of the slowdown. We might test these lows, but we probably won't go lower on the PPO. Usually when we retest lows, as you see, go back again to our favorite time. Well, let's just go all the way back to 1987 too. So we can see what that looked like, and then also 2008. So if I were to go to a weekly chart and then come all the way back here to 1987, you can see as we retested the lows, the PPO, in this case, the PPO actually, the PPO will continue lower as we retested the lows. And then when we made this run higher, it started to move up. If you go to 2008, that's actually 2002. There's the big selling was in July of 02. There's a retest of the lows. PPO got a little bit lower. There's another retest of the low with a much higher low, and then away we went from there. There's 2008. There's the big selling in October. The PPO bottomed out in November on the first retest of the lows, and then when we got the lower low, it was a much higher low on the PPO, and that was a big time bullish divergence. And you can see how, again, the transition candle, upper and lower shadow, and then closing above the high of that candle. You see over here, we didn't close above the high of this candle. Here's our transition candle, bullish and bearish. We got it. We turned around. We got some bullish candles here, but we never closed above that high. The closest we got was over here, but we had all these other highs that we just hit the 50 and rolled over. So you can see how significant it is to close above. You can see over here, it took a couple candles in 2010 to close above those highs. So watch for us here. Pretty much these two are right on top of each other. If we're really going to be bullish, if we're really going to reverse, again, at least to the 50, watch us to close above these highs. I don't expect that we will. I'll expect we might get up there tomorrow, but I don't think we'll close the end of the week on Thursday. Remember, there's a holiday week this week. Above those highs. So we'll see. We'll see. Again, we've seen in the past where the PPO continues to go down as we, during the retest of these lows. The very, very first retest of the lows. Let's look at the 3 green arrow chart. And you can see SPY is getting still 2 green arrows. We still don't have the third because we're still below the 30-day moving average. And if you look at the 2 green line version of this, you can see the 8 still below the 17. I mean, that's a good break above the 17. Great. We're still below the 30, and the 8 still below the 17, and both of them are still below the 30. So, we've got some, the first 2 stages are to get above the 8-day moving average and to get above the 17. Price to get above the 17. So we have the very, very first 2 stages. The very last stage is, in this case, using these indicators, is to get both the 8 and the 17-day to both cross above the 30. And obviously, we're not close to that pattern yet. Let's take a look at the intraday chart, the 4-week range here, and you can see that gap. I mean, look at we filled in the rest of that gap, but it pretty much filled in the whole gap overnight. We opened up just above the gap. So all that filling in here occurred overnight on extremely light volume. We finally opened up. You notice not a whole lot of volume on this. So that's why I don't think that this is a breakaway gap. There wasn't significant resistance for breaking above. There wasn't a big increase in volume here. It was a good day of volume. It was a little bit of a bounce over Fridays, which was really light, but not a big increase in volume. There is some. That's what I think that we could get another day of buying up towards 275. I think that's a very real possibility to fill in that gap of volume here. And it might just occur overnight. We might open up there. If that happens, I don't know. I don't think it will. But if it opens up there, then we're gonna have a really good opportunity to sell that gap and fill in that gap. And then as we fill in this one, it's gonna take a lot longer because there's a lot of volume below now. If we, see even just where we're at right now, there's a lot of volume below. So we're not going to tank down to these lows. We're not going to tank through these lows. If we get below 240, we might start to pick up the pace a little. If we fill in this gap, if we fill in that gap, we're pretty much going to 210. Is my guess here. There's a very good chance that we don't. As you can see, that's the bottom of the value area on this 4-week chart. But if we fill in this gap, we're not just going to 218. We're most likely going, because people will be looking for double bottoms there. We're more than likely to go below that and really sucker people into thinking that we're not going to bounce up, and then we'll hit that support at the 210 area and look to bounce up from there. So, but again, don't be surprised if we don't fill that in. I mean, like I said, it could very well fill in overnight. It might fill in early in the morning. It's a big, gaps get filled, even volume gaps get filled. So watch for that to get filled before we roll over and have, and fill in this gap eventually. That's kind of what I'm expecting there. Again, looking at the volume and the trading range. Whoops, wrong one. Right here. The volume at 187 million, well below the average, so 187 million. The trading range was well above average. That's not good. Right? We don't want, when we go to the upside, we don't want big trading ranges. Those are bearish to get big trading ranges. And big, for that matter, big volume as well. But we didn't get that here. Let's see, let's go to, it is this one. So 18 points in the trading range. I mean, that's way up above. Right now we're at 2.6. So 2% is 5.2 points. In fact, if we do, it'll be easier for me, my elementary math skills. A 3% move is 8 points. And right now, that's the trading range is at 13. So if we're going to be bullish, then, and even on the pullback, don't be surprised if we don't get small moves, because, again, on the pullbacks and subsequent bounces, ups and downs, this will be falling back towards 3%. So the ATR will be falling, in this case, back towards 8 points. So back down into this area before we form the low, as we've seen in the past, multiple instances on these big time spikes in volatility, that we typically hit that 3% mark before the low point is formed and we bounce up. And you can see volume 187 million, well below the average. That's a very, very good sign. But again, that's bullish for these lines to go down. So it's great. That means the extent, this hardcore selling, and that we're just, the world's going to end selling, that's over with, right? We're going to be dropping here, and that's good. But it's not necessarily bullish yet, right? It won't really get bullish until we break down below 3%, and then these break down to, that's when we have the low point set, and then again, getting below 1%, now we're just on the bullish trend to the upside. Now we've gone past the volatility, and we're really moving. The equivalent level, on the VIX would be to get below this 90% mark. So, we're hitting some. You notice the VIX didn't go down today. We gapped down, but it stayed. As bullish as we were, it stayed here. So, and we're kind of, right at this 100 to 105% level for some support on volatility. Don't be surprised if we don't bounce back up. I don't think we'll bounce up to 125 or 130. We're not going to bounce up here again. But if we don't, don't be surprised if we don't bounce up towards 115%, which would mean, again, the VIX probably bouncing up towards 60, maybe higher, but maybe up in the 65 area. But 60 to 65, I think, is where the next VIX bounce will take us, and this will probably get up to 115, maybe 120 at the highest. And that, again, I expect that to happen, if not this week, pretty darn soon, early next week, like sooner rather than later, because of the support we're hitting. And I don't expect it to drop. And if it does drop quickly below 100 like this, what I could do way over here when we were at the worst of the selling, you notice it dipped briefly below 100 and got right back above 105. So if we dip below 100, I don't expect it to get below 95, and it'll be brief, and we'll pop right back up above 105 really quickly. And then, like I said, get that move up towards these levels like we did over here. So to summarize, we had a really good day today. We've been talking about this idea of retesting the lows being such a popular concept that we needed to knock some people off the bandwagon by going higher first. High enough to get people thinking that we won't, that we get more and more people thinking that we won't retest the lows. And today we kind of saw that in action. We saw there wasn't a lot of chatter about retesting the lows today. It was, in fact, it was less common and more common that talking about how bullish we are and how great this is and breaking above these highs and what can we buy and can we start getting in now. And I mean, that was all the discussions that I saw on financial media today. At least most of the discussions. And that's exactly what we want to see. We wanted to see. So because we do expect that we retest these lows. That's how the market works. That's how investors behave. That's how they've always behaved. Whether they were in 1920s or whether they were in the 2000s or now in 2020. That's how they behave. To a smaller extent on the intermediate pullbacks, but especially on these long-term pullbacks. We get the hardcore selling, which abates. We bounce up really sharply, historic moves to the upside like we saw. And then we hit some resistance at these falling moving averages. We've already hit the 17. Now we're looking at the 30. We sucker people off that bandwagon of retesting the lows, and then we fall, right? Again, where the market can produce the most pain. And the more and more people think that we've breaking through some resistances now, and now we're moving higher, and they start loading up on bullish trades, the market will cause the most pain. And that's when it will start retesting these lows. You know, if there's a lot of people sitting in cash right now, then moving up is causing the most pain. But as you get people nibbling and it's, you know, trying to see, okay, you know, we're through the worst of this, and they start nibbling and getting in some bullish trades, now we get some more pain to the downside. And as I said, when we retest these lows, there's a good support level at that gap, that potential runaway gap from March 24th. If we fill in that gap, don't be surprised if we don't go all the way through 210. You can bookmark this for later viewing if you'd like, but that's my expectation. I think there's a good chance we hold that runaway gap for a support level. We don't go below that. But if we do start to fill it in, I think we go all the way down to 210. And that will really get people scared and bailing out and going into cash and getting bearish, and then we'll turn back up and we'll be done, right? We'll be done with, you know, that will be the lowest low. We'll retest the low. We might get a higher low later, but then we'll be done at that point. So what do you think? Do you agree with that technical assessment? Do you disagree? There's a link popping out right there on the top right corner of your screen. Click on that link. It opens up a poll. You can hit either agree or disagree. If you click disagree, comment down below as to why. What are you seeing differently? What's causing you to have a different opinion? Everybody's got their opinions, right? So it doesn't really matter what your opinions are, especially on an anonymous message board, or a video or comments, unless you share with us what's driving that. What indicator you're looking at, what charts you're looking at, what's driving that, and then we'd love to share. You know, if there's something I'm missing, we'd love to share that with our Market Scholars community here. All right, now let's talk about what's driving the price action here. And you can see, you know, we still have over the past, this is a 3-month chart, a comparison chart. You can see bonds, gold, the dollar, global bonds are all still high yield bonds, also the best performing asset classes over the 3 months because we were so bearish, and even crude oil dropping down today, even with the jump in stocks. Crude oil is down, and small cap stocks underperforming. But if I were just to go back to that March 24th, you know, to the gap that we had up, we came off the lows. So off of that March 23rd low point, the lowest close, the S&P is up almost 20% now. SPY at least is up 20%. Real estate has been doing very well. I mean, that was a big performer. So our preferred stocks are still two of the best performing asset classes. You can see small cap stocks still lagging behind large caps over the past few days, especially in terms of this rally. Again, that's what was the leadership beforehand. Small U.S. stocks, large cap stocks, growth stocks, they were all leading value and small cap and international. When we rally up off of significant low points, it's usually international, it's small cap, and it's value that leads the way higher. So the fact that those other three factors are still leading the way, again, is another sign that I'm not really that as bullish as this bounce would suggest. You can see gold's been bouncing up over the past few days with the dollar down. Even the dollar's been rallying. If I just go back to the past a few days here, or off of this really off of this low point. So actually it's going to be about, yeah, let's say 4-1. Let's go back to 4-1 here. So that would be 1, 2, 3, 4 days. Let's go to this 5-minute chart. Interestingly enough, crude oil's up 30% in those 4 days. Big jump higher. We already had a pretty decent move there, but you can see gold is up 6% in those 3 days. Stocks are up 3%, but not outpacing. You can see bonds are even up, just barely underperforming stocks in the last 4 days. Again, think about, if I go back here, in fact, let's go back. If you think about what these 3 days were that preceded today's move, you have to go to, here, let's go to this chart. And then you see, okay, 1, 2, 3, and then the open of that. So really from this to here is what we're seeing in those 3 days, right? 1, 2, 3, because it includes that open right here. So from that close up to this high, that's what that 3-day chart is looking at. So when you go back to this comparison, you say, okay, recovering all those losses and then a little bit more on the S&P 500, you can see, there it is. So this is the open down on Monday, then we rally, then Monday, Thursday, Wednesday, Thursday, Friday, and then gapping up here. So there's the open, and then up to this. Again, crude oil obviously has had a really good run at the end of last week, and then giving back some of those gains today. But you can see how gold and bonds are still very good, and the dollar for that matter, very strong performers, even with stocks bouncing up. So again, not something we want to put a lot of stock into in terms of how bullish. Crude oil bounced down with this postponement of this deal, a little bit of a Harami pattern. Again, kind of an idea that we might retest these lows. I would imagine until Thursday's meeting that crude oil will be pretty steady and not make too much of a move. Again, we don't need it to go up, but we do need it to not go down significantly, right? Today's downward move was not that big of a deal, but if we were to break 20, that would be a significant move, and obviously that's going to coincide with the stock market dropping too, because the stock market can't stay. It can stay up with crude oil making a small drop or lagging, but it can't. And as I tweeted out, as you saw me tweet out today, but it can't stay up if it falls through the floor. So that's been a significant mover lately, and of course the dollar index, with its peaking up here, with this whole rally again that typically coincides, as we saw here and over here. Remember how the dollar was rallying, we thought, and the market was rallying too, and I said that's not usually a good sign. That's not good for stocks that the dollar rally as much as it did, and then we dropped here as we saw, stocks dropped and so did the dollar, and then stocks continued to drop as the dollar spiked up higher here. So it's not a good sign for stocks for the dollar to be rallying, and it's on a good bullish trend. Until this thing breaks that trend, it's going to be hard for us to really get going to the upside on equities. And of course, the other important thing to keep an eye on is bond yields, and bond yields made their own little run up to the upside. But again, these can be brief little turns to the upside. So yields are so bearish right now, it's going to be really hard for them to really get going to the upside either. As bullish as this Hakinyashi candle looked like for equities, with this little transition turnaround, we're not getting that yet on yield. So we're not quite there in some of these other asset classes that you expect to join equities to the upside. Crude oil is just barely getting its own little reversal pattern here. So we're still not quite there, but we're getting closer, as we talked about, to the end of this risk-off pattern that has been going on for stocks since early 2018, and for commodities and small cap stocks since October of 2018. We've been in the bearish run ever since then, and then now we're capitulating that bearish run. So there's a good chance now we're getting towards the end. October 2008, as bad as it was the end of that bear market that peaked in October of 07. And so there's a good sign that we might retest these lows, we might go down a little bit lower, but this capitulation move we have with coronavirus being the spark that caused this, technical environment that was set up in this technical environment. This, think about like a really dry desert, like in California, and all you need is a spark to get those fires going. Well, coronavirus was a spark, and that got the fires going because we were so dry and there's a lot of fuel to consume. And now, once the trees are all burned, and there's nothing left to burn, then we can get going again. I know that. I mean, just right over across the highway here from where I live, we had big fires up the canyon. And once the trees all burned, they got the fire out. Then that was able to start the new growth. So I think the fires burned, right? And we got all the acres burned here. Now we're slowing down. Now we're containing. We might get a little flare up here and there, but the burn is contained, and now the new growth can start. If we do the same comparison for the sectors, we go to the same chart for the sectors here. You can see again, first going from that March 24th low point. Again, you can see the biggest winners, not surprising, is energy stocks of 33%. It's a big move. I mean, that's 33% gain in 5 days or however many days. That's a tremendous move. Crude oil's up, utilities and real estate are still top performers, still up 24%. Again, that's not the leadership you want. You want these sectors down here, and they're starting to. You can see discretionary is starting to, communication services is starting to, and technology is starting to. And they're starting to lead the way higher, but they're not quite there yet. Let's go back to just those last 3 days, right, where we reversed the drop and then some, just a little bit more. This is what the sector rotation looks like. And you can see the outperformers are energy and consumer staples. Technology with a little bit of outperformance as well, and utilities and real estate lagging. And that's okay. That's what you want to see. So we're getting a little bit of green shoots there, but still not quite. That's still not the leadership you want to lead bounce up higher either. If you take a look now at the 12 grid for all these different sectors, with your cyclical sectors at the top, here's your dollar sensitive areas. Lots of light green, lots of red lines, yellow line on technology, yellow line on staples and healthcare. Again, these are bearish patterns, typically. Now they also precede bullish reversals, but they're also, they can be pretty significant bearish patterns. And as we get more and more of these, again, it might take another day to get more of these yellow lines, which means we close above the moving average, and as well as the S&P. Then that's where we're going to be like, okay, it's time to retest these lows. We've suckered in all these cyclical areas. Financial still not able to get going. Utilities and real estate, they've been so bullish because they were so bearish, but they're still pretty bearish. Now we'll retest these lows at the bottom. And when we do go down, if you see utilities and real estate go down the most, since they bounce up to most, and some of these cyclical areas hold up better on the rebound, on the test, on the move down, that's the most ideal. To kind of give you a comparison, this is the chart from the November 9th low point up and back down to the March 9th low point. And as we got up and back down to the March 9th low, you can see it was not the safe haven. Industrials and financials led, they really bounced up hard. But see how technology and discretionary held up really, really well. And you would assume communication services in there too. Again, that was kind of stuck in its own little sector there at the time. So that would have been, up in this area, and that's what we want to see. You want to see, as we go up and back down, that these cyclical areas, as we retest these lows, that they don't go down as much. And utilities and other interest rate sensitive areas, real estate in this case now, because that didn't exist back then either, that ETF, they would be the biggest losers. So let's watch for that as we bounce up and back down. We've already seen utilities and real estate lead the way up. Now we need to see, okay, on this retest of the lows, are they going to stay up and hold up their value, or are they going to go down more? That's when we'll know we're getting towards the low point, is when the cyclical areas go down the least from that point. So again, March the 24th is the, right now the 24th is, if this is the low, this was November 20th, so it was a little bit after. In fact, if you go back to October the 10th, where we had the worst of the selling, so you go back to there, to that low point, you can see how utilities led up first. and then they pulled back down to those low points, as I said, from that low to that low. So from this low to this low, you can see utilities and staples held up the best, right? So that means that that wasn't that low point. But then from that low to this low, that wasn't the case. And if we see that happen, then we know that this is the low point. When from the chart that we just saw, from this November 20th low to that low, utilities did not hold up the best. And these safe haven areas did not hold up the best. It was the cyclical areas that held up the best. That's when we know, right, that the market is shifting. And we're not seeing that yet. We're seeing more like this. So that means we're still retesting the lows, and we're still going to be, and this took a few months for that to happen. And that brings us to our trade idea of the day. And I wanted to take a look at a sector again that, if we're doing this, and you can see technology leading the way down and going down on that retest of the lows, if that ends up being the case, then you're going to see stocks like Intel that are showing some pretty good bullish patterns right now. You got the dark green shading even, because you're barely crossing above 50. Obviously still a yellow line, breaking above some highs, hitting some resistance here in this area. In fact, if you look at the Bollinger Bands, you can see that we're hitting that resistance here. So here's a good example of a stock that is kind of giving you some sucker, some kind of some patterns that would sucker you into thinking this thing is taking off, right? In this case, look at the 8 and 17 day are crossing up above the moving average, without ever getting this crossover to the downside. You look at these long-term moving average lines, you can see how it's crossing above the 50 and the 200 right now, much less just testing it. So, obviously the week's not over with. We're just a day into this 4-day week. If you look at its Ichimoku cloud, as I mentioned on the S&P, we're above the blue line and have been, and the greens cross above the blue too, but we're still well below the cloud. It's still going to be hard to get going. You can see we've been bearish over here, but if you're still above the cloud, it's easy for it just to go back and follow the trend. Right now the trend, isn't as bearish as it was, but we're still below the cloud. It's going to be really easy for this to come back down, fill in that gap, since there wasn't a whole lot of volume on this move. If you take a look at today's volume here for INTC with this gap, you can see, not a whole lot of volume here to say that this could be a breakaway gap, breaking through this resistance, especially considering that we're actually getting up to resistance. The other thing too to consider is this DMI pattern. You can see the crossover again occurring, where, as we saw in some of these other stocks that we've looked at lately for bearish trades, here occurring below 20. So getting above 20, but not above 25 on the positive line. So it's kind of this faux bullish breakout pattern here, and that those kind of moves are very susceptible to selling them. So if you take a look at like their options, we can look at selling the $50 put and buying the $52.50 put. So that gives us a long put that costs us 46 cents. You can see how we are managing risk, and in the live session we got in about 58 cents. That's why we position size with this. This is a half of a normal position of what we do in our classes. And you see, so down just a little bit today as we finish higher. But the idea is if we come down towards this 50 level, then we can get a 3-to-1 reward to risk at the worst case scenario. And if we do break out to the upside and this thing holds, then if we can keep our loss to half of that, to this $250, then that ends up being about a 6.5, almost 7-to-1 reward to risk ratio. So very, very good reward for a little bit of risk that we're taking in this trade, on this speculative trade, expecting that Intel will kind of follow suit, with this kind of bearish pattern and fill in this gap and work its way back down. If not, it doesn't have to go all the way to these lows, but at least fill in like this gap here and get down towards that $50 level again. And like I said, if it breaks out above 60, then we say, okay, then because that volume node's right here, right, that resistance. So if it breaks above that, then we take a small loss, half of our max loss, and we just move on to something else and look for something else that we can either, if the markets do roll over, be bearish on, or if that coincides with kind of a breakout in the market on the S&P, then that will change our tune on that as well. But here's a way to be really speculative, or at least be directional, be speculative with a small amount of risk, but get a good reward, if this plays out as we expect it will. All right, well, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link that's popping out in the top right corner of your screen. That will take you to our Market Outlook forum. That's one of the things you get for free on our site is access to that community, to that forum there. Open up any threads with any questions or comments you have about today's Market Outlook video, anything I talked about, or if you have anything that I didn't talk about that pertains to what we have been discussing, and reply to other people's threads too, and let's keep this conversation going in between. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on our video down below on what you got out of tonight's video. Follow me on Twitter for more content in between videos, and join our Market Outlook community at marketscholars.com as well as on Facebook. Have a great rest of your evening, everybody, and we'll see you all tomorrow.